Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, October 27th, 2021. Here's what I'm going to cover in this video. We're going to start out with the equity markets. I won't spend a lot of time there, but there is certainly some things I want to point out. I'm going to cover the Nasdaq 100 as well as the small caps, Russell 2000 index, then an update on the sugar trade, a new setup in the 5-year Treasury bond. Usually I'm covering the long bond, either the 30-year bond or the 10-year Treasuries. This time around I want to point out some developments on the 5-year note. We'll do updates on natural gas and crude oil, and then finally aluminum, do an update there. All right, starting out today in the market, sort of like Dickens' classic novel, Tale of Two Cities. We have a tale of two tapes. One tape, the tape on the Nasdaq 100 is strong. Where QQQ is up 0.86%, not bad, close to 1% up. Nothing's changed technically. We're still right below those previous highs, so there's still the potential for a double top here. There's also potential for a breakout, but you guys know which way I think it's going. There's a nice clean uptrend line right there to trigger a short entry. That is a bearish rising wedge right there. That pattern you can see here, bearish rising wedge. There it is. This and this, just like we had one back there. That was our sell signal last time, led to the biggest drop in many, many months, so forth and so on. That's what we look for, or at least what I look for. Divergent highs, divergent lows. And so again, no sell signal here. I'll get to the small caps in a second. We had a sell signal there recently, but regarding the whole tale of two tapes thing, so there's one way to look at the Nasdaq 100. That's certainly healthy, right? But when you look at the equal weighted Nasdaq 100, because I talk about this a lot, in recent years, these big market-leading FANG stocks have had more and more of an impact on the market. The QQQE is the equal-weighted Nasdaq 100. Holds the same basket, 100 companies, same 100 companies, except it applies an equal weighting to each one. That's a huge disparity, guys. I haven't seen that in a long time. That is down almost 0.6% versus the Nasdaq 100 being up almost 0.9% right now. And you just don't see that often. And what it means is you can see the double top it just put in there. And when you look at this, here's something I came up with years ago when I started using TC2000. Figured out a way to get real-time breadth indicators, and up until then, and I don't think today you're going to find them real-time anywhere. Sometimes they're usually delayed, and then the thing about it too is they only give you the a couple major indexes, not the Nasdaq 100. You get the NYSE and I think the S&P 500. You'll quote market breadth. But when you pull up a component list of an ETF in TC2000, what all I do is here is I sort by percentage change. Here I'm going to stretch this out so you can see what I'm doing. And this gives me real-time breadth at any given instant, any second in time. It'll tell me what the breadth is in the on that index, if there's an index tracking ETF. And again, this has all 100 components. You can see down here on the very bottom it says 100 items. And what you do is you click on the lowest one. So I sorted by those that are gaining today, and I click on the last of them, which is Apple, which is almost flat, about to go negative, but again, this is changing second by second. And you have 26 out of the 100 stocks positive. So 1/4 of the stocks in the Nasdaq 100 are up. The other 3/4 are down today. And again, yet you're up almost 1%. Why is that? Well, there's the FANGs. Alphabet, Microsoft, Tesla's. Somebody asked today if I'll start including that, which I will now that they're in the elite $1 trillion club. They certainly have an impact on the market. So there's Tesla adding to the gains, Amazon. You got it, guys. So that's why the Nasdaq 100 is up. I talk about that weighting. And if you're in the Nasdaq 100, if you're trading that, great. But when it goes the other way, and the FANGs break, then they have an over weighting to the downside as well, and that's why you have that extra volatility in the Nasdaq 100. But again, I wanted to just point out that it is unusual to see the disparity between the two. Here's a daily chart right here, or we'll leave it on the daily chart. You can see the Nasdaq 100 QQQE in white, and then in purple I have QQQ. And I studied this, believe me, before the video, and I've covered this before. I've showed you how to use that as a kind of an idea for what's going on with the market breadth. Now, again, I just showed it to you with the percent gainers and the percentage losers, or the the advancers decliners. So it's about a 3 to 1 down, or 3/4 of the stocks in the Nasdaq 100 trading negative today. And then look for the disparity between prices. Sometimes one will outperform the other by a little bit, but rarely do you see them going completely different ways. Look, what does it mean? One day doesn't make a trend. I say that all the time. Let me say that again. A single day doesn't make a trend, but it is sort of a heads up, especially with two more of the big FANG stocks on deck this week. So we'll continue to monitor that. But now let me show you what does make a trend real quick before I move on to the small caps. Okay, so if one day doesn't make a trend, what does make a trend? Many days. Many days, many weeks, many months, and sometimes even many years. So this is this chart here. You're looking at the Nasdaq Composite on the bottom, and the NAAD, which is the Nasdaq advancing versus declining line. So this line up top shows you the number of issues in the Nasdaq composite which are advancing versus declining. And here's back in 2009. Really was late 08 when the Nasdaq 100 bottomed, but every other index bottomed back in March of 2009. So we're going to go there. You can see in a healthy market, as it should be, during these bottoms, you have the NAAD going up, meaning you have more stocks advancing than declining, right? Makes sense during a trend. But what happens? All trends get long in the tooth, and then all of a sudden you have fewer and fewer stocks going up, just like today. And what it is, it's almost invariably it's these market-leading FANG stocks plus some others, but the ones that attract the most money. Crowd favorites: Microsoft, Amazon, Facebook, now Tesla, and the likes. And so what happens is when they start to diverge, and you can see it here, I forget about that line up there, you get these corrections, and those divergence sometimes continues, just like the negative divergence on my indicators, like the PPO and MACD and all that. Then you have a correction. That was a bear market. Doesn't look like much. About over half the index value got wiped out in the great 07-09 bear, and along the way we've had some pretty healthy corrections. And again, they weren't random. There were a lot of other things besides breadth deterioration, but that is a signature of a market top, or at least it's what occurs before the big corrections. You can see here everything was healthy, hunky-dory. We still had a big drop in the fourth quarter 2018. And I always say these are not timing indicators, they're showing you market conditions. However, although we didn't have the divergence on the NAAD, we did on other indicators. We even had negative divergence on the momentum indicators. A lot of that. We were short that thing and caught most of it on the way down. But then when COVID hit back here, you did have divergence on the NAAD, and you caught that 36% or so drop right there. It was, again, signaled by the divergence. This is where the divergence started, the blue line. And that's it. So I'm not going to go over a lot of these indicators. I've covered these in the past. Sometimes I dedicate an entire video just to the divergences, but there it is. So you can see the divergence building, and again, by that I mean the number of stocks advancing in the Nasdaq 100 has clearly been falling for months now, while the index continues to push higher. So if history repeats, I think these kind of divergences are not immutable. You can't use that word, because immutable means they cannot be changed. They can be burned through. It's just very, very rare, and you go back in time and you just hardly see that. So it's more of a matter of if, or I should say when, versus if we're going to have a correction and these divergences play out. Again, it's not 100%. And most importantly, it is not a timing indicator. I'm going to get to what a timing indicator is in just 1 second here. Before I do that, I just want to show you one more breadth indicator, one of many. I've showed this one many times over the years, including recently. Up top is the NAA 200R. That's the percentage of stocks in the Nasdaq Composite that are trading above their 200-day moving average. So you can see the scaling to the left. You don't see 100 because you never have 100% of the stocks trading above, and you don't see 0, but that's where it would be bounded, because you cannot have more than 100% of anything trading above, that's moving average, and all 100, all the stocks in the composite, nor can you have none of them trading below it. I mean, all of them trading. So in other words, you get what I'm saying, guys. That's going to be 100 or 0. And the extremes are really down here, just below 10, and up there to about 80, which we just hit. And but most importantly, I use this again, simple divergences. You can see it. I did not put the Nasdaq Composite down here in log scaling, or is it? Oh yeah, it is log scaling. It looks like there. Okay, so yes, you can see the size, the scope of these corrections, these bear markets, and these are all double-digit corrections. And many of these, 30, 20, 30% or more, 50 something percent right there. And this one is TBT, to be determined. But what is absolutely certain is, like just about every single breadth indicator I have, and they can be used for looking for bottoms too, and you get these divergent lows, but every single indicator I have is showing the same thing: clear deterioration of market breadth, and it's just a condition of the markets. Those big fangs have gotten to the point where they are just absolute earning juggernauts, and but they all correct. I've gone over the charts many times, go back decades for those years, and they always have big tops right after record earnings. I mean, these guys consistently pump out record earnings, quarter after quarter, if not each and every quarter, but it seems to be the majority of the time. So I just wanted to say that, don't, the fact that Alphabet just reported, record earnings, that's par for the course with these companies, and that is usually it comes right around their tops as well. And what it is, they just get saturated. Too many. When the last bull has bought his or her share of Apple, Apple's a great company. It'll be around, but it's you go back for throughout the history of Apple, you'll see plenty of double-digit corrections. So we need to get those sell signals, and you guys know where those are. I'm going to cover that in well, I have covered that recently, some levels to watch on those big fangs, but let's look at the small caps now, because that is where we recently got a sell. Okay, this is RTY. Now you can be trading IWM. There's a lot of proxies, to trade small caps. RTY, which we're looking at here, are the futures, the Russell 2000 small cap futures. And if you don't, if the contract size is too big, you're just getting your feet wet with futures, M2K is the mini contract. Goes off the same level, so I don't post M2K charts. There's no reason to. It trades on the same number, just has a large, smaller multiplier, meaning a smaller leverage factor in there. So you can use the same charts to trade that. And of course, IWM is the go-to small cap ETF. You want to short it, you can buy, RWM, that's the one-time short. Then you have TWM, the two-time short ETF, and then TZA, the three-time short for small caps. So you pick your poison. Usually best to stay away from the three-time leverage ETFs for anything but very quick in and out trades. But on an index, you can go with the two times. Nothing wrong with that. The K really isn't bad, if at all. And especially if you catch these good trends. So it's playing out so far. I told you we had a little whipsaw, but I maintained the sell signal on it, and it just pushed up to make a slightly higher, pretty much tested the top of the wedge, extended that wedge a little bit, and nice move down so far. So from the top, this one's dropped just since yesterday. What is that, 2.5% so far? Impulsive selling, that's what you want to see after a breakdown. Like I said, sometimes that's it, you never look back, and sometimes you have a little kickback rally to back test the wedge or the pattern, whatever it is. And I still maintain these targets, 22.48, and or the downtrend. At minimum, I'm saying we're going to come to the downtrend line. It's just a matter, do we hit that first bounce, get there? So this would be my minimum target. And when you look at comparable sell signals in the past, the drops have been much larger. That was the smallest one right there. So if you go with the average here, it's going to say we're going to get more than that. I'd say we're going to come down to at least this area here. So if you want to swing it for a little while, and then, okay, so this is, once again, that's a sell signal, a breakdown, and a back test provides another objective entry. But what's the sell signal on the Qs? Well, we've got one. We're still, that sell signal I gave you weeks back, months ago now, is still in play very much. If you shorted it here, you're back where you started. Your break even if you didn't cover on T1 or T2 or when the divergence built or anything like that. So this trade is still in play if you look at it that way. I posted many opportunities in here to game it, active traders to reverse and play a bounce and then to reshort. But just want to say that was our sell signal. However, and this will be a whole new sell signal or objective short entry for those either not short, wanting to get short, covered, doesn't matter. A break of this trend line will be a sell signal. And then you can see all the levels there. Those are levels you're likely to get reactions on. Many of those were levels on the way down here before, but since we had reactions on them again, like here, traded on that 373.50ish to 374.50ish level. There was a gap back here, then it was resistance. Provided an objective short area, shorting op back then at the time. And then when we broke it there, it acted as support. So now that becomes resistance. So this is what you're looking at. Most likely, if we get the sell signal, break that, and then break 378.44, probably hit that level, bounce, and so forth and so on. Quick update on sugar. Sugar so far good for about a 5% bounce off this trend line here, what was highlighted, and that support area around 19-ish, a little below there. And there's a minor uptrend line, so if you're in that one, keep that in mind. But again, the buy signals come, and this is a quirky one. I usually don't show buy signals like this, but it just seems to have a history. When it hits this lower line there, right there, that was 1, 2, we came just above it there, didn't hit it, but then we put in divergence. 3, 4, so far 4 for 4. If you just bought the PPO down to this extreme level of negative 1.2, it is literally that simple, and nothing's 100% in trading. So you see these patterns, you recognize them, you take a shot, you put a stop a little below in case it doesn't play out, but so far it has. And at this point, there's no reason not to trail up stops. I would move your stop up to a little below that 1948 level right there. It's pretty good. It was a target that was hit on the way up, and now it becomes support. Next stop. I think there'll be some reactions here in the middle somewhere there, but that's a pretty good target right there if you're holding on to sugar for a little bit longer, about 0.2036. Okay, so for the first time, at least in a while, I'm long the 5-year Treasury bond. Again, I like the ZB. Usually you get more bang for your buck. It has to do with duration. Duration is how much a bond will move in response to any a certain change of 1% move in interest rates. So the longer the bond, like the 30-year bond, Treasury bond is going to have higher duration. In other words, you get more bang for your buck. However, the chart, and I just actually posted quite a few trades on ZB recently, both longs, even where to exit that one. But as of now, I like this chart. It's just a little cleaner to me, and that is we put in a divergent low right here at the bottom, and we're starting to break out. I meant to include this one as a setup the other day in the video, but it's fine. We're just breaking out now. We were here the other day, ran up, had a pullback, but we're starting to break out. First target, and it's also resistance. You could add to maybe a partial position here in case it takes one more jog down. If it does, it's still going to have divergence. So I still like it if you're willing to give it some room on the 5-year. And then next buy signal would come on a break above that 122.008 resistance level. Next target 122.144. Remember, these are unadjusted targets, actual resistance levels. So sell below the one that you want to set a sell limit order a little bit below wherever you're targeting. Right now, I can see a move up to probably the maximum move if the charts stay constructive about 123.071 right there. There's pretty good support that it fell through. That it, broke down below that support right there, and so that would be a potential target. To the best of my knowledge, they don't have an ETF out there that trades solely trades the 5 year. The closest thing, and I'm going to show you those. You have, and if I'm wrong, just post it below in the comment sections. I just never trade it. I usually, if I'm trading bonds, especially I like futures, you've got to put a lot into an ETF to make much. Here's SHY. This has the 1 to 3 year treasuries in it, so it's a sort of a mishmash of 1 to 3 year treasury range, very short term. And this also shows you what's going on. Short term rates have been going up recently. It's a matter of time. Inflation's hot. Powell, as I said he'd be, has been proved wrong repeatedly. My God, when he's going to just cow down off his inflation is transitory thing, I have no idea. He's still trying to maintain that. But the Fed is slowly backpedaling, as they always do. Anywho, so with that, we know rates are going to have to be raised at some point to put this inflation into check. Something's going to have to give, and that's where, and I'm going to get to commodities in a second. The commodities that have really held things up, crude oil, natural gas. And when the brakes really start to come on, that's when those guys will probably really correct. But again, I'll get to those in a second. So SHY, this is a weekly chart. You can see that forever and a day we were moving down in a price channel here, and we broke down below that channel. And there's really not a lot of support on the 5 year coming in until you get down around this way. So this was, remember, this was when the Fed back here actually came in. This is the nuclear response to COVID right there. And so rates are just going to normalize and at minimum get back to where they were. But now that inflation's so hot, I think there's a lot more downside in bonds, meaning upside in rates. And as I've been maintaining since the Fed did that, bonds have to have absolutely the worst risk reward profile in history, at least in my lifetime, meaning the upside potential, and they're paying next to nothing. So if you're lucky, we stay in a near zero rate environment for the foreseeable future for years to come, and you earn a paltry less than 1% on your money. However, since bonds are rate sensitive, when rates go up, you're going to lose a lot more in your principal than any potential interest payments on those bonds. So that's why that's horrible. Now, that being said, that's long-term stuff. And just translation, I wouldn't put your 401k money and have a lot in a bond fund if you plan to leave it in there for the next 5-10 years. I think that I'd rather be in a money market account than a bond fund. But other options here are IEF. So that was a 1 to 3. This is a 7 to 10. So you kind of split the difference. And what you're looking at here is this is a weekly chart as well. IEF has fallen to a pretty decent support right there and took out this downtrend line. And so remember, when you're looking at bonds, it's inverse to rates. When you want to look at rates, and that's what I'm going to do for you here. I started out with the 5-year Treasury bond futures, and this is the yield. So if we want a direct apples to apples comparison, you look at FVX dot or dash X on TC2000. It's the 5-year Treasury yield, and that's it. So you can see what it's done. I have a big old resistance zone right here from about 1179 down to 1017. We hit the top of that resistance zone. It was very good support back here for a while, back in 2013, 14, 15, 16. And then once we broke it, and that shows it was a very significant level. Once that level was taken out, the 5-year yield fell off a cliff. And so now we're back to it right now. We're back to that breakdown point, and we have, again, this is a weekly chart, we have nice negative divergence to boot. So that leads me to believe we'll probably have a correction at minimum back to the bottom of the wedge, that uptrend line right there, which takes us back also to the bottom of the support zone around 1017. Probably get a reaction there, but then we could break down. We'll see. What would cause that? Weakness in the economy. I told you I'm longer term bullish on rates, but if this wedge develops, we could see that happen. I mean, remember, there's a lot going on in the bond markets, a lot of unnatural market forces. Left alone without massive central bank intervention and U.S. Treasury intervention, you'd see bonds pretty much reflecting economic growth expectations as well as inflation expectations. But don't underestimate to what extent the central banks are willing to go. So either way, I'm just looking at this point in time for a pullback to that trend line. Again, if you look at the weekly chart, and if you go to the daily chart, you can see here there's that nice support shelf right there. It's resistance. And so as you can see, we didn't quite hit it. I had that level at 1297, which is really about 1.3% yield on the 5-year right there, and we're just shy of below it. So I think if you can give it a little room, it might have one more pop up in yields, which would mean one more thrust down on the 5-year note that I just showed you. ZF again is that symbol, and this would be your target right here. You'd want to line this trend line here, this uptrend line right there. There's our primary trend line. It was broken, back tested, and now we're at or just a hair below resistance on the 5-year yield with that negative divergence in place. So and just to give you guys an idea, if you trade ZF, the bond futures, the 5-year, it represents about $122,000 of underlying in the 5-year note. So do the math on it, and whatever percentage it goes up, you're making that percentage on about 122,000, or losing that percentage. So keep that in mind. So always know your leverage factor, position size in futures. And again, you want to trade the ETFs, you can do that, but it's a capital burner. You're going to have a lot of money, especially in the short end of the yield curve. The 5-year, 3-year bonds, they just don't move up that much unless the Fed's doing something crazy with rates, which I don't foresee anytime soon. Okay, next up, natural gas. Somebody asked about natural gas under one of the recent posts. I put up this chart, and my comments were, there's really on the, well, I've already covered the intraday charts. We're going to get to that in a second. We'll look at the 60-minute charts. But what really stands out to me, and I mentioned this in my response, is most of the time, 90+% of the time, I'm trading natural gas. I'm in and out. I'm hit and run. I'm actively trading off the intraday charts, typically the 60-minute chart. And those are trades that are going to last either days, usually just a few days or a few weeks. Because with natural gas, in a few days, you can make 20-30% in the right move, or at least in a couple weeks, no problem. That's how it's the nature of the beast, very volatile. But in this point in time, if you're willing to give it a little room, this is the bigger picture. And by give it a little room, well, how does that work on a volatile security? You just can't put a very large position size if you're going to try to trend trade it and catch a major top or bottom. But what I'm looking at here, and I did this because a lot of people don't trade futures. They do have mini contracts for natural gas futures, so you don't have to trade NG. I think it's QG, I think, if I'm not mistaken, is a small contract for the natural gas futures. But this is a weekly chart. Again, it's posted on the site. You can pull that up under one of the recent posts. And there's our primary downtrend line. This goes all the way back to early 2014 right here at this downtrend line. And we just hit it. We just kissed it almost perfectly the other day right there. And I'll try to move that over. No, I can't do that. Got to go back. Okay, so we just kissed it. So number one, you had that. You also have resistance around 22.22 on UNG. As well as nat gas futures, you have resistance as well. This was bullish. Here was a bullish falling wedge pattern. This is when I like to look, and I pointed out at the time, very bullish posture on natural gas. That's where trend traders want to start getting long. And this is where trend traders might start taking profits. So when you go back, this chart goes all the way to 2012, and there were only 3 times going back that far, 3 times that on the weekly time frame UNG was overbought, and that means above this red line, which is a 70 level right there, and I have each of them circled. And so this overbought reading was a great short entry, and they're not exact timing indicators, but it's, hey, get out of your longs, start to get into shorts, start to look at the 60-minute charts and the daily charts and natural gas futures for trend lines and things like that to trigger an objective short entry after you get the overbought readings. And before all is said and done, off that overbought reading, UNG fell 85%. And it didn't just randomly stop after that 85% drop. It did so with positive divergence. There was also a nice trend line that you could have had there, positive, bullish falling wedge, and then it broke out here and had a run up. I didn't measure it here, but I can tell you it's from about where we are today, about 20.46 up to about $39. So that's pretty hefty, almost a double in price right there. And then what happened? Well, that run ended, again, not arbitrarily, but with the first overbought reading in years, going back to early 2014. And when it got overbought, by the way, at resistance, not just random there as well, but there was nice resistance, previous reaction high. Before all said and done, it fell 80%. And once again, not a random bottom. It did so with positive divergence. And then following that, you had a breakout right here. And so that's it. Went from $8 up to about $22. So that's a nice return. And that's it. So I just wanted to point out nothing's guaranteed, nor do I expect another 80% drop. Why? Because I've made a very strong case for the last year or so that commodities have entered a new bull market. We're in a new era of inflation, and these were drops within a larger bear market. So I'm not looking for anything close to an 80% drop. But if we pulled back to that 1488 target, that would be a nice pullback trade from about 22 down to about 15 right there. And so that's it. So you can see the PPO is starting to turn down at high levels, poised to make a bearish crossover. Hasn't done so yet. That's what happened last time we had that overbought reading. And then here as well, you had a high level bearish PPO crossover as well. So that's not enough evidence for you right there to at least be on the lookout for a short trade, and then I don't know what is. Okay, and just an update again, this is Nat Gas Weekly, so these are long-term chart of Nat Gas futures. And as mentioned, we ran into resistance recently, this previous reaction high right here. Perfect kiss of it. Stopped there, pulled back to the trend line, and as expected, that's the first time we tagged the trend line in a while right there. And because of that, we got the expected reaction so far. Pulled back, and as I said, we need to take out this trend line to trigger a more powerful sell signal on that gas. So break of that will most likely bring us down. Your first support is going to be there about 480, and then I think we could probably come back in down to here to about that 380-ish level right there, somewhere in there. Again, overbought, extreme overbought on this one you're looking at here, and extreme overbought, these green readings when you can see it get well above that 70 level here on the futures. Okay, and on a somewhat related note, there's crude oil. This is the chart I've been showing for a while, the WTIC, West Texas Intermediate Crude. It's crude futures right here, big level back here years ago. That round just shy of $80, broke it. It was a meltdown in crude oil. Years later, we rallied to back test it, failed. Another really hard rejection before all said and done. Crude went even negative, crude futures for a short period. And we just recently came tested it, had a reaction there, rejection, and popped it, and we're above it now. So as I've been saying, you got to give it credit for what it's done, trading above there. But if and when that fails, which I suspect it will, why? Because breakouts that occur with negative divergence have a much higher rate of failing than those that are breakouts that occur without the divergence. And so again, simple stuff. If unless they can burn through the divergences soon by going up higher, this is what happened last time we had negative divergence, this right here. That doesn't look like much, but we went from about 45 down to about 35. That's a big drop in crude, negative divergence, so forth and so on. Okay, so you don't want to short off the daily chart or the weekly chart or even daily chart in anticipation of a false breakout that may or may not happen. So what do? Well, you zero down in on the 60-minute charts right here. It's a nice clean uptrend line right there, just waiting to be broken, triggering the next objective short entry into crude. That trend line comes off the I think it's the August 22nd lows right there, and as you can see, we continue to diverge. We had negative divergence here, and you had a correction. Divergence got a little bigger, another correction. Divergence still grows, and so there's our negative divergence right there, divergent high. And so therefore, we also have very good price support about 81. So if you want to mark your, not your calendar, but set some price alerts on crude futures, a drop below 81 should do the trick. Target 78.80, 76, 75.60, and I think we'll come all the way back down here to 72.43. Representing a drop from where we are right now of about 12.5% should we get that. So let's just focus on that now. First things first. And again, that would be a break of the trend line and the 81 level to trigger a sell signal. And last but not least, just a quick update on aluminum. Aluminum futures, I told you, are very thinly traded. Look at these sparse candles. This is the December, the current contract here. There's our drop. It's about a 15% drop. This is where I mentioned it as a short entry back here recently. We had negative divergence. This is a 60-minute chart, by the way, guys. There was our divergent high. Divergence has certainly played out. We've had about a 15% drop, but as I said, you might want to go with JJU. Even though it's a thinly traded ETF, there's been more volume recently. Again, you can see the selling down here, and you already got the charts this morning. So I first posted it right here on that candle. That was, I think, early October, about 2 weeks ago. We went up from there marginally. I mentioned it's aggressive, but I said you can start scaling in here. To me, the correction looked imminent. There was only about another 2.5% upside. Then I followed up right here once we broke the minor trend line right there, mentioning that's another objective add-on or new short entry, and boom, hit my trend line. But as I said in there, you have support right below about 55.70, good support. So this is where we'll probably get a reaction. If you're trying to game a bounce, that's where I'd game it up to about 50, or just get out. Made a quick, if you make a quick 10, 12, 15% in just a couple weeks. Nothing wrong with taking it out. And look, aluminum, just like lumber did a few months back, got way ahead of itself, and so I can certainly see the possibility of more downside. This is my maximum target right now. I'm just not as confident that we just melt down on through there and hit that 49 level without much of a reaction. Again, I think the buyers will step in here, take it up here, and do something along these lines if we are going to head down there. But being that we're trend line and price support, to me, it just wasn't worth holding on anymore for that. Again, if you want to do it, all I'd advise is set a stop. Now, the problem with this too is this is an ETN. It tracks those futures. This trades 9:30 to 4. And it's already liquid enough as it is. I don't even know if you can trade this one in the pre-market and after-hour session, but you're not going to get a good fill on it. So my point on that is this little guy is subject to gaps. Futures are going to do what they do, and then you can gap up or down, and a gap can bypass a well-placed stop. So let's just say you had a real tight stop here, but you could gap up here tomorrow above that stop. So you got to keep that in mind, and that's why on something like this, thinly traded, probably best to just take the money and run right now and regroup and see if we get another objective short entry. Or if you want to go long, sure, case can be made to go long. Just set your stops not too far below. You can see the levels that I have as support. Okay, guys, long video, and for that I apologize. I probably should have broke it down into a couple different things, maybe one on the markets and the rest on these other trade ideas. But either way, they're all out there for you, and that's it. That's what stands out to me today. So let's just wait and see. Got to sit tight on the markets, see what the FANGs do. The last of the two to report, which again will be Apple and Amazon reporting tomorrow after the close. So we're really not going to have an idea as to what the market, market's going to need time to digest all those reports. And so at best it'll be Friday before we have any idea if those, if that QQQ is going to break down, and it might be early next week. But just to wrap it up here, I did give you levels to watch, so we can all figure on what may or may not happen. But I can just say as clear as I can be that this is an important trend line, and Break below that. Ideally, a solid 60-minute close, because again, those fangs could provide some whipsaws if there's a knee-jerk reaction, when the market opens after Apple and Amazon report. But like I said, it looks pretty good, and I think the risk reward even warrants, if you wanted to take a speculative position being short going into earnings with that double top high, you could do that as well, but it's more aggressive. All right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.